Markets have become bored very quickly with trade tariffs as a theme, although the underlying problem hasn't disappeared. However, after Friday night's close, Moody's downgraded US debt, citing increasing debt levels and increasing costs related to that debt. Francois Savary, hello.
Hello.
Thank you for joining us. Do you think the market's going to take this as an excuse to take a breather and take a look at the underlying fundamentals?
I would think so. I think that, as you mentioned in your question, people tend for the last few days to consider that the tariff issue is no more an issue, and I think that they are wrong. At the end of the day, that was some good news. Obviously, it's much better to have an effective tariff on Chinese goods at 45%, but nevertheless, it still remains that the tariff level that the other country are going to experience when they want to export to the US remains significantly higher than it was during the pre-Trump era, and so I think that you need to be careful. So at the end of the day, the news by Moody's that we had on Friday tells us that there is room for some consolidation on the market, and this development could be a pretext for the market to consolidate in the coming days.
10-year bond has just creeped up above 4.5% this morning. I don't think it did that during the recent run up, although it may have done very briefly. Do you think that's what is your new target for bonds now?
I still reckon that, and you know that we have expressed the view over the last few months and weeks that it's very difficult for us to consider that there is any room for really running after the duration trade and try to pick up the duration trade. I think that you need to be careful because you have some comparison that are coming and saying, okay, when you had the downgrade by S&P in 2011, the effect was quite limited and etc. and etc. And so we should not be too worried. The second element is that remember that during the period going from 2010 to 2020, interest rates were going down. Clearly, what we are experiencing since 2022 is an increase in interest rates. At the end of the day, the 10-year bond yield has been doubled over the last year and a half when you consider the evolution of rates. So this is something that you need to take into account when you decide, do I really want to purchase long-term bonds in the US 10 years and above? And I still reckon that it is not necessarily the case. And I still believe that you can get to a 475 in the course of the next coming months, depending on different elements where the visibility is quite limited.
Despite inflation rates remaining quite benign, the 10-year bond yield and the 30-year as well, in fact, are remaining remarkably uncooperative. This has all sorts of implications, namely fiscal, for the US government. Do you think this would encourage them to reassess their proposed tax cuts?
When you look at development lately, it was, I think, on Friday, they reject the proposal. The Commission of the House of Representatives rejected some proposal, but finally, over the weekend, they came out with a solution. So they are moving forward with the idea of cutting taxes. So I think, no, for the time being, they are still trying to find a way to put some budgetary impulse into the economy, which could be worth about 1% of GDP growth next year, but it's something that they are keen to do. It's not necessarily from there that you need to expect a support for the treasury bond market. I don't think this is where they can really find the support. To move forward with some kind of tax cut, I think is at the end of the day going to unsettle the market.
Could we have a situation whereby, and I'm not at all suggesting that this is going to happen, but whereby the Fed cuts interest rates and the bond market disapproves and it increases yields on the 10-year bond? I can't remember the last time that happened in markets, but do you think that's a possibility?
It's a possibility. You have a possibility. Depends in which condition the Fed decide to cut rates. As I mentioned before, you have a lack of visibility on the economic cycle. I think that it's very difficult for central bankers, especially for American central bankers, to assess which kind of economic outlook they need to consider for the coming 6 to 12 months. because you have a lot of uncertainties on inflation, you have a lot of uncertainties on the growth prospects. So if they cut rates because suddenly there is a fear and they cut rates where inflation is not under control, the market could react very negatively to such a development. So it's all the combination of growth and inflation that will determine if there is such a development.
You've been cautioning against increasing bond levels in portfolios for several months now. How have you changed your portfolio? What have you changed it into? And is this news from Moody's? Does it encourage you to continue making more changes?
No, I would say that I would stick with the idea that we remain on US government debt. We remain quite cautious and we don't want to buy it. We consider that lately we had some positive development for economic outlook. That's something that we need to keep in mind. When we move from April the 2nd reciprocal tariff issue to the level of tariff we are today, it's a good development. It means what we have decided to change is our assessment of the potential economic scenario that you can expect for the coming 6 to 12 months. We have reduced the probability of a recession. We have never been keen on that idea, but nevertheless, we consider that with development lately, we can reduce. Nevertheless, we have increased the probability of stagflation because we still are worried about the inflation outlook in the US, despite the fact that CPI and PPI numbers lately were quite good. So on that front, that's one of the adjustments. But be it a recession scenario or a stagflation scenario, I'm not sure that it is positive for the bond market. So I believe that we need to stick with what we have decided. We still prefer short to medium bond duration, and we still prefer credit to US government debt in our allocation. And if there is one thing that we have done lately, is we have increased tips in our allocation in the US. We have introduced a position on index inflation-linked bonds in our allocation.
Coming to the week ahead now, S&P PMI numbers coming out this week. I imagine the market's going to be riveted to that to see if there's any signs of a reduction in global growth.
I agree, but what I was looking at the consensus lately this morning, and clearly people are expecting that in Europe, the trend towards an improvement is going to materialize, which would be something very positive for Europe. In the US, there is a deterioration that is expected, but it's quite moderate. But you are right; those numbers are going to be the focus point of the week for investors, considering that we still have this lack of visibility on the economic outlook. And remember that on Friday, we had a very poor number concerning consumer confidence. Michigan index fell and was, I mean, at record lows nearly. So this is something people are going to be very cautious, and they want to see what is the development of the economic activity, especially in the US.
I know you wanted to talk about the European election results over the weekend. Elections in Portugal, Poland, and Romania. What is your takeaway on that?
Surprise is the word, because when you look at what happened in Romania, it's a good and positive surprise because we have somebody who is able to work with the European Union, which is less anti-OTAN, anti-EU, anti-NATO, sorry. And so I think this is a positive development. Surprise in Poland, because in Poland, people were expecting the center-right guy to be much more ahead than his rival. And I think this is not a positive development. Poland is a very important country in Eastern Europe. So we need to wait for June the 1st when we will have the second run. And Portugal, I think that we have both of positive and negative news. Positive news, the center right is able to lead the polls. Bad news is that the far right or more nationalist or populist leader is gaining more and more votes in the election. And so it makes the prime minister job in terms of trying to find a coalition even more difficult than it was before the election. And what is also not a good development for Portugal is the fact that you had less population voting. So it means that people get tired to go to the poll. So all in all, I would say it's not a too negative development for Europe. This is something that could help produce the consensus that Europe needs to find in order to move forward with many, many important plans that they need to bring forward concerning military, concerning foreign policy, concerning innovation, etc., and etc. So that's, for me, it's a positive development, all in all.
François Savary, thank you very much indeed. Thank you for joining us, and I look forward to seeing you next week.
Okay, have a good week.
You too. Bye bye.
Bye bye.